You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that tune means it's time once again for Volatility Views, the premier program for volatility traders. If you're just joining us for the first time, first off, shame on you. Where have you been for the past 3 years? No, we don't chastise our new listeners. We welcome one and all here to the program. This is indeed the program, our once a week look back into the week that was from a volatility trading and analysis and research perspective. My name is Mark Longo from the optionsinsider.com, as well as from the ever exciting Options Insider Radio Network. And if you're new to this show, well, this isn't the only program on the network, not by a long shot, folks. We have, I believe, 13 programs on the network now, so quite a few choices for you to select from on said network. If you're into futures options, we have 2 shows for you. If you're into volatility, of course, you have this program. We also have our option block program where we get into a lot of volatility-related trading topics there as well. If you want some more basic education, Options Bootcamp and Options Playbook are for you. If you're looking into the financial advisor realm, perhaps you are a financial advisor or asset manager, you want to learn how to use these options things better, or you're looking for an advisor and you want to learn what kind of skill sets that you bring to the table, the advisor's option is for you. And if you're into unusual activity, well, the option block and options oddities are certainly some good bets for you. So no shortage of shows. I'm sure I'm forgetting one. Oh, yes, Trading Tech Talk. If you're interested in the amazing tech that powers all of the trading that goes on behind the scenes here in the trading and financial technology world, very hot topic in the post-Flash Boys type ecosystem and universe, well, then check out that program. That's a fun one as well. And we're adding new ones all the time, listeners. So if you have an idea for a show we're missing on the old network, let us know. We'd love to hear from you. No shortage of ways for you guys to do just that. You can find us on the website, theoptionsinsider.com. Find us on iTunes, Stitcher, Aha Mobile, or of course shoot us an email and listen to all of our shows via our mobile app, which is available for iOS, Android, and the Fire OS. We try to make it as easy as possible for you guys to access the shows and then give us your feedback, your ideas, your suggestions on them. We do this for you guys at the end of the day, and we love hearing from you. That's what makes it all worth it. And joining me on the old Volatility Views panel today, starting off with the man taking a break from his busy hosting duties on the Options Oddities program to join us here on Volatility Views. He is the Rock Lobster himself, Mr. Andrew Giovinazzi from OptionPit.com, and our editor-at-large for unusual activity over here at the Options Insider. Mr. Andrew, welcome to a show that you don't host.
It's so odd because I'm so used to hosting. I don't even know what to do when I'm not hosting.
If you like, I will happily sit back and let you run the whole show, sir.
And run the gamut and just pepper Jared with questions. I love that idea.
So you'll be the host. I'll sit back and Jared can just answer everything. That'd be great. It'd be a real long show for Jared. It'd be very relaxing for me.
Hey,
Thanks, guys.
You could crack open a frosty beverage,
Yes.
put your feet up, and take the afternoon off.
It is Friday. It has been a long week from a content perspective. Done a lot of talking this week. I could use a show off, but I wouldn't do that to Mr. Jared. No, of course, we're also referring to Mr. Jared Woodard. He is the equity derivative strategist over there at BGC Partners, and has once or twice been referred to on the show as perhaps a major domo. Mr. Jared, welcome back to the program, sir.
I'm always glad to be with you. I absolutely refuse to carry the show today, but I'll do my part. How about that?
All right. We'll have equal parts from all of us if you guys insist. Making me work for my money here. I'm not sure what you guys have planned, what you have up your sleeves, but you're taskmasters, both of you. All right. With the Volatility Views crew assembled, we're going to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
Welcome to the Volatility Review segment. This is indeed the portion of the program where we take a look back, a nice wistful glance back at the week that was from a volatility perspective. We are recording this today, Friday, October 24th here, right around 1 p.m. Central here. So a little bit of time left to go in the old session. If you've been playing along and watching the markets, and I know you have, you know it's been a tumultuous week, to say the least. We're experiencing some volatility once again. That's kind of been our refrain for the past few episodes, and it's kind of nice. It's kind of refreshing to have some actual vol trickling back into the markets again. You know, for so long this year on this show, we were talking about, man, where's the vol? Where's the vol? I realized the vol is at like a 5 or 6% out in the S&P. Well, these days it's hovering around a 20, so we're actually seeing some movement. A lot of movement to the upside as well these days, and a lot of people like to talk about the biased nature of volatility. They tend not to really think of upside moves as volatility, but yes, that's a movement, folks. I hate to break it to you, but it counts as volatility, and it certainly is feeding into what we're seeing in the markets yesterday and again today. The markets, most of the major indices up again today, up about half a percentage point, pretty much across the board. And surprise, surprise, VIX Cash also ticking up about 1% on the day to about 16 handles or so. So we're hovering right at the low end of the weekly range here in the 16.5 or so range. We saw quite a range in the VIX Cash, as you might expect, over the week. And earlier in the week, seeing it start off the week right around a high of about a little over 23, dipping as low as about 15.5, and now it's kind of been vacillating around this 16.5 point here for the better part of a week. And, you know, it's I hate to spoil our crystal ball segment, but it's kind of hard to foresee it getting a heck of a lot lower in the near term if the indices keep moving the way they are right now, because like I said, we are actually experiencing some actual volatility in the marketplace. So we're not back at the 4, 5, or 6% days that we were talking about not too long ago. So if the markets keep rocking like this, or we keep having this Rocktober, to use a beaten to death cliche that we've been seeing in the markets over the past few weeks, it's kind of hard to see VIX Cash and the futures getting a heck of a lot lower than where they are right now. But who knows? Mr. Jared Woodard, always good for a little bit of controversy, a little bit of point counterpoint. Perhaps he vehemently disagrees. But before we even get to that, Mr. Jared, what caught your eye in the week that was from a volatility perspective?
This was one of those weeks where this week and last week, too, you saw, as you said, you know, with these big rallies in equity markets, realized volatility was actually increasing on several sessions in which the market was moving higher to such a great magnitude that you had the standard deviation measure increasing. We were just moving so far away from the recent mean on the upside that realized vol measures were all ticking higher, even as implied vol on the option side of things was coming in. And, you know, we see that sometimes. It happens when the market's really, really churning higher, but it's always notable, to me anyway. And it's been interesting to track this week as well. Which markets and which parts along the curve have responded and how they've responded as markets rally. One thing we haven't seen is a kind of return to where we were 2 months ago. There's still, I think, quite a lot of after effects, aftershocks, as it were, that are echoing out through the options market. And even though, you know, VIX futures aren't backwardated the way that they were, a lot of the front several months in premiums have come in. there's still quite a bit of flatness in a lot of implied vol curves, and I think that's something that it could make an interesting setup going into the end of the year.
And Mr. Andrew, aside from all your myriad duties on your various shows and, of course, the chat room and what else, what's been catching your eye out there in the land of option pit from a vol perspective over the past week?
I have to agree with Jared. Normally I do because he's, a smart guy. You actually should have a dumb guy on the program that we could make fun of, and then it would be a lot easier. But Jared's kind of hard to disagree.
Well, we had Sebastian last week. We can only come on once in a while, So.
Okay, that was funny.
Make sure that one gets back to him.
That was funny. I'm gonna have to relay that one. Anyway, I'm a kind of a VIX future curve watcher for all you home gamers. And, a flat curve is normally a nervous curve to me. And right now, November future trading 1760, March future trading 1870. That's only $1.10 for 1, 2, 3, 4, 5 months. Just it's not a lot of curve. It's not a lot of a premium built into the curve. We do have a little contango because the market is going up. It's not free falling. So. But that's still, I think that's still a twitchy market. And I like with clients, they're like, well, Andrew, how low do you think vol can go? I go, in the next 2 weeks, maybe 15. Until we really see a slowdown. I mean, every Ebola headline seems like it sends the market up or down 1 or 2%, just, on some goofy thing. And, there's real fears there. I don't know how catchy it is, but, I am not a biogeneticist or anything like that, but it seems like it's got a lot more hype than substance, even though, unfortunately real people die when they get it. But what that's doing to vol and with Europe, I think that the big turnaround we saw from last week is every time the market tries to wean itself off of QE, you have those kind of sustained sell-offs. They trot out some Fed governor to say, well, QE can still happen, which kind of felt like what they did last week. And the ECB, well, we might buy a couple of corporate bonds. Is any of that really going to change anything? However, that language somehow gets into the news reading algorithms and they go, oh, QE, buy. And you have these just vicious uprips. And, like Jared said, I mean, we have the upside volatility has been as bad as the downside vol. So, to me, you have a volatile market when the up and the downside is in play. And I think still both of those are in play. And that's going to keep, the VIX in the 15, 16 range, at least for a little longer. And this is a part of the earnings season. By now, VIX should start trailing down kind of hard, because most of the big earnings are out. They have been okay, not great, but, certainly not economic catastrophe. And it's hard to believe with the corporate earnings at a record high that we have interest rates that don't really exist. So there's still a lot of funky disconnection going on. And, vol can go up real fast, but it tends to go down slower. And it takes a while for traders to forget about that, the skeevy short contract feeling that they had just recently last week. Normally it takes a little more than a week for it to wash off before you have kind of that willing seller step back in and start hammering premium. So the skew's in a little bit on the downside. They crushed call premium. I haven't checked on it yet today, upside skew. So I saw those types of things happening, which normally is people are starting to relax a little bit. But we'll see, if it remains. So that's kind of where we are. But I still think that there is a veil of nervousness in the market. And I think the vol futures generally are pointing to it, and they're not incorrect.
Yes, a lot of stuff cooking out there. You're right. The vol futures are a little bit perhaps flatter than you might expect, given everything we've been seeing. And, of course, the near term of that curve has been vacillating all over the place. We're backward. We're not. We're in contango. We're backward again. That seems to have come off. The near-term anxiety, anticipation, premium, whatever you want to call it, built into that near term of the curve seems to have come off a bit again. So we are in a relatively flat period for given everything else we're seeing out here in the old VIX futures land. Moving on to the VIX options, of course. And from a VIX options perspective, as you might expect, a very, very robust week. 2 days north of 1 million contracts, and a third yesterday pushing 900,000. So very, very robust volume. The VIX alone averaging nearly 700,000 contracts a day right now. So we're into robust territory. As you might expect, all you guys looking at the sentiment out there, looking at the different sentiment indicators, and have written in asking about, hey, looking at how call heavy VIX is. Now that the VIX is, well, at least not, it used to be, is not as high as it once was, away from the low teen levels, but still the open interest reflecting that movement as we're seeing that call heaviness coming off. Quite a bit. It's only about 2.2 to 1 now, calls versus puts, again, reflecting that kind of structural issue we see built into VIX options a lot, that when you're particularly down the lower end of that range, there's not many put strikes to trade. There is one exception to that. Let me bring that up here when we're talking about the top trades of the week, the hot strikes, I should say, of the week that caught a lot of people's attention. The number one of the top 10 here is, of course, the Nove 20s. Not a big surprise there. They're near at the money Nove calls there. 365,000 open, getting a little bit longer term on number 2, the Jan 20s, coming in for 217,000. But what caught my eye here on this list, the number 3 overall hot strike for the week here, in total in VIX as well, has just rocketed up the charts. It's flirted with the number 10 spot a few times in recent shows and seemed to have gone away, and now just back with a vengeance. These are the D's 13 puts holding down the number 3 spot on this list. This is the highest we've ever seen a put. Any strike of puts on this list. And for some size, too, about 214,000 contracts open on this strike. So people are loving, for whatever reason, that D's 13 put seems to be where there's a lot of interest and a lot of activity. I need to check into that more and see what's going on exactly out on there on that strike. I know we profiled a few weeks ago people buying size upside and the VIX calls, but then not too many size players out there in the D's 13 puts that we profiled, and yet this strike continuing to pop up on our list and just rocketing it up this week. So clearly some love and some interest down there on the 13 handle in D's. Moving on to the number 4 strike, of course, the hot potato of Nove 17s for 200,000 contracts, followed by the Nove 25 for 182, the Nove 22s for 167,000, then down to number 7 and number 8. A little bit more put love, not as long-term. The Nove 14 and 15 puts for 158,000 and 153,000 open respectively. And then the number 9 and number 10, the Nove 20s and the Nove 24s and the Nove 30s. Some little optimistic folks there at the end there. 135,000 and 134,000 roughly each open on those. So some put love, getting some love out there on the old top chart for first time in a long time that I can remember. Total of about a little over 6 million contracts open out here in VIX land right now. About 4.2 of them coming on the call side, and just a hair shy of 2 million coming on the put side. We did see some interesting paper going up today as we're recording as well. Looks like some size sweeps to the upside here in the Nove VIX options, with the Nove 25s and the Nove 18s both getting swept about 20,000 times each, pretty much right near the offer. So they're gobbling these things up here. So a total of 40,000 contracts going up in some near-term Nove VIX call upside. Tons of open interest on these strikes, so it's hard to tell if those were closing. I'm going to perhaps go out on a limb and assume that they were. But interesting stuff going up here nonetheless. Before we move on to some other products, Jared, I know you pay attention all week to what's cooking out there in the OTC realm. We talked last week about how perhaps maybe some of the recent regulation has kind of tamped down on some of the action, some of the liquidity out there. In fact, that was kind of one of the big stories going on in the broad financial media this week, talking to Volker and others saying, hey, do you think your rules are starting to exacerbate some of these moves because the liquidity in these products just isn't there anymore? So clearly that's a drumbeat that they picked up from our show and ran with it. But what did you see out there this week from an OTC vol perspective, Jared?
Okay, well, as you might expect, there was a lot more hedging of some broker-dealer and bank and other positions over the last several weeks in the swaps market. But I think what really stood out more than anything else was this heightened discussion about the character of the liquidity of people's positions, not just in equity markets, but in bond markets too. There was some news that came across today that the SEC is taking a harder look at bond funds and whether some of the bond funds that have gathered a lot of assets have had to, get into some fairly illiquid products in order to deploy those assets, and the potential for this to cause some instability and market stability problems during the next major correction or anything worse than that. And so you get the sense that regulators are taking this pretty seriously. Lawrence Fink at BlackRock was in the news this week as well, mentioning that he expected higher levels of market volatility in the year ahead. And this is something that we've been talking about on the program for, I guess, a couple months now, looking at the year ahead and some of the factors that could drive markets higher. And I think that, like we were talking about last week, the effects of regulations that have been designed to increase market stability are probably, as far as I can tell, really effective at actually increasing market stability within the normal range of market activity. But the effects of some of those regulations might have, I hate the phrase unintended consequences, because people use it for sometimes the most nefarious or boneheaded sorts of critiques of regulators. But it's true that sometimes some of these programs and some of these changes to market structure and market participation can push people who would be natural liquidity providers or natural buffers in the private sector, can push them out of the picture, whether those are banks or hedge funds or asset managers or whoever it might be. I think it's important, if we're going to have a private system, then I think it's important to make sure that well-intentioned regulation doesn't cause some of those liquidity providers and some of those key players to basically have their hands tied at the worst possible moment.
Yeah, a lot of the hand-wringing this week seemed to come over lack of liquidity in the bond market and some of the rates products. But, of course, we focus here on the OTC vol side of the space. But a lot of those same players dabble in both. So if the players are missing in one, it stands to reason that perhaps there could be a few missing in the other product as well. Speaking of other products, looking here, we've kind of done a lot of hand-wringing on this show about what's up with VXST, what's up with VXST, when's it going to catch fire, when's it going to actually start trading. And this week, actually, given the fact that we saw some movements, we didn't see a heck of a lot of paper going on in VXST. In fact, through like a lot of the lion's share of the big moves yesterday and the day before, we saw 63 contracts going up on Wednesday in VXST, 122 on Tuesday there, 100 on Monday. In fact, not until today, all of a sudden, for some reason, today, VXST is just lighting it up to the tune of 2,000 contracts going up today. Pretty much all of those on the call side, only 7 puts. 2,007 contracts have traded today, listeners. 2,000 of them being calls, 7 being put. So for a whopping 285.7 to 1 call to put out here. That's about that's a decent amount, especially given the recent ADV is about 800 contracts out there. It has dropped considerably from what it was recently. So today, a lot of love coming on the NOV calls, as you might expect, but it's not big blocks, as you might expect, going up out here in VXXT. A lot of the 200 lots of the NOV 18s going up for about 800 contracts. That's probably the largest big trade. Those are all obviously related, so you can consider that an 800 lot block, I suppose. But the rest are smaller trades for the most part, 100 lots and smaller. So it's interesting to see what days VXXT actually catches fire and the use cases people have for it, because it's not going into the days you might expect, like the non-farms, or the days like we've had this week where the market's really rocketing. It's a day like today where it's up, but it's not as aggressively as it was, and there's no other big factors cooking that really would drive a lot of near-term paper, and yet here we go, VXXT off to the races. Does that surprise you as much as it surprises me, Mr. Rock Lobster?
Well, I was just noticing the sizzle factor is 4.7. Of course, I wasn't going to guess that on relative to the ADV. That's a little joke from our oddity show.
That is quite the sizzle.
It is quite the sizzle. I think a lot of this is, and maybe Jared can correct me. I'm looking at, because I've been watching the product a little bit. I think a lot of it is now kind of more having to do with sort of where the futures are in these products. So like I'm looking at the money around 18 for the NOV cycle future, which is the week before Thanksgiving. And again, looking at the volume without seeing it maybe, that 18 level starting to entice people. Selling the 18 vol in the future, so they're selling some upside calls. So I think since you do have a little bit more, let's just call it action in some of these near-term futures as the players get a little more used to them, I think it's a function of just kind of where those futures are priced and how it just brings the paper in. That would be my observation, but we'll let Jared chime in on that. But it looks like that 18 level. It's you got an 18 future. It's before Thanksgiving. All of a sudden you're selling the Nov 23s for $1. Maybe it's starting to get people a little excited about selling some of that juice in there now that they've got a feel for how the product moves. That's my take.
Jared, do you agree with that take? Or are you going to take the Jane, you ignorant slut crossfire counterpoint here? Which way do you fall, sir?
No, I don't. I can't disagree with anything Andrew said. That all sounds reasonable enough to me. I mean, for the amount of time that we've spent really begging these new products to move and to get some activity, I'm also not going to exclude the possibility that we're collectively responsible for all of the volume that ever happens in any of these new. I mean, who else is promoting? The exchanges and the providers and the ETN creators, I mean, they do their share of promoting their own products. But when it comes to talking about new and interesting volatility products and just begging every week for something to happen, no one does it quite like Volatility Views. That's
true. Your friends at the SIBO should pay attention to that, because you're right. I can't think of any other outlet anywhere that even mentions VXST, let alone pries into the paper on a weekly basis, trying to decipher exactly what's going on out there. And I think you could certainly make that argument on the days when it's doing 30 contracts a day that we are attributable for all of that paper. 2,000, maybe there's someone else playing in there as well, but we can easily drive 30 to 100 contracts here amongst ourselves, no problem whatsoever. Talking about what's cooking out there in VXST land, the OC21s on the 29th cycle, expiration cycle there, are the big draw, followed by the Nov 24s. Those are expire on the week of the 12th there. And then that's pretty much the two big positions, 500 lots open of each. And the rest kind of goes down from there, Nov 20s and Nov 19s, Nov 22s, Nov 27s. And then some 50 lot of the Nov October, 14 puts expiring on the cycle of the 29th there. So not a heck of a lot open once you get beyond the initial strikes, but some decent paper out there. Maybe with a couple more days like this, we'll see that start to change. All right, moving on into some of the other products that have been exhibiting some volatility, some action of late. We touch on the commodities, and the big commodity that everyone's playing along with these days and following is, of course, crude and what's going on out there in the energy sector. In fact, listeners, if you listen to our option block program, we like to play that trading patterns guessing game on a regular basis. And this week, as an ode and homage to Apple's earnings, we pulled up Apple to see what the folks on the OX platform were also trading, who were trading Apple. And surprise, surprise, both times we did it this week, the number 1 through 3, or sometimes 1 through 2 spots on that list were the crude futures. So people who are slinging Apple stock also out there slinging crude futures. That shows you that that crude has reached a level of saturation and penetration, even with the broad retail, that a lot of other names simply can't claim. So that is interesting in and of itself. And we've talked a lot recently about how the skew out there in oil, if you just threw it on a wall and took the legend off of it and said, hey, guess what skew chart you're looking at, you probably would guess a stock, because it looks just like that. It looks like strong investment skew with a heavy bias to the puts. And this week, not much has changed there. It still is strong, heavy put bias to the downside, with a lot of these contracts starting to get into the put wing, trading into the mid-30s from an implied vol perspective. So people clearly willing and wanting to pay up for some protection, some downside protection in crude, which is interesting given the fact that I think a lot of people might think that the majority, the lion's share of the bearish move out there has kind of been spent. We're vacillating right around the low 80s to the 80 handle right now out there in crude land. Maybe some people concerned down to the 75 land, but I don't know, a lot of people out there who are worried about a continued protracted move, like another 10, 15, 20 handles like we've seen recently out there. But perhaps there are a few. You never know what the Saudis are up to. Jared, we touched on those crazy tinfoil hat theories last week. I think we can dodge most of those this week. But what's your take on what's cooking out there in crude from a volatility perspective this week?
Well, Mark, you've seen a move higher in implied vol in crude, and it doesn't look like the story has nearly abated. I mean, I think that the biggest change in terms of coverage that I've seen over the last week or two is a deeper focus on some of the economics of producers and where their break-even points are, both in the U.S. and around the world. And as that's happening, we're seeing both WTI and Brent implied vols remaining really high. I mean, I was looking at Skew this morning in Brent options, and 1 month implied vol today is higher than it was a week ago and a month ago and 3 months ago at the money, and those out of the money strikes, especially like on the put side, like you say, have been bid up right in line. The biggest change on a relative basis that I can see is it's actually some flatter skew now coming up in the call side in Brent options, where it was almost upward sloping, implying some really significant potential for volatility, even to the upside, say 3 months ago. Now you've just got flat or lower bids in out of the money calls on Brent, which I think is consistent with the outlook that this thing is not going to snap back higher, that there's some kind of a more longer term and significant move that's happened here that has more to do with the economics and fundamentals than it does with just positioning or leverage. That's I think borne out across now, starting to affect everybody that's tied to energy. And you have equity analysts talking about how this is going to affect the companies that they cover, and so it's really spreading out, I think, into how people are pricing options and resetting expectations across the whole market.
And Andrew, I know you guys mostly focus on the ETF side, watching USO and a few others. Has the big crude move, has that caught fire with your clients and in your chat room? And if so, what are they catching on to out there? Are they mostly looking at USO, or are they starting to play around in the big futures and options as well?
Yeah, it was for a while. We had some traders looking at the downside flies and stuff like that, but it's kind of cooled off now that it's sort of stuck at this level. I still can't quite put my finger on sort of the magical 20-point drop in the price of crude oil, which, I try to, I know it sounds funny, but, obviously there's more buyers, there's more sellers than buyers, and that's why it went down. But, normally there should be some sort of headline, inventory issue, or, something along those lines that's like, well, hey, but clearly literally like beginning of October, all of a sudden crude just took a dump, and nobody really has a good answer for why that is. And the only thing all of a sudden the U.S. is getting output off its, out of its shores, or they're saying, well, we don't need to import as much. One of the two things are happening. So it felt like it was a huge sea change type move. It was fairly quiet, but all of a sudden the price of oil just went kaboom. So I don't think a whole lot has changed from the demand side. And, this sort of long awaited drop in oil prices, I guess, is finally happening. I mean, we're almost at $40 a barrel. I'm sorry, USO was almost $40. What was that, like $120 a barrel? Now we're, 89, 82, 83, something like that, the spot price I was just looking at. So, the U.S., it's like one of those things, I guess it's kind of like the peace dividend in the 90s, after the Berlin Wall fell, and President Clinton was a big beneficiary of that, being able to cut, lots of defense spending and stuff like that. And that eventually reverberated through the economy in a big way. The internet revolution didn't hurt either, but that was kind of a sea change. And now all of a sudden, if we have low oil prices for the next 10 years or 15 years because the U.S. is pumping so much of this stuff out, I don't think any of that has really sort of seeped into the broader market. That could have been part of why we rallied to recent highs, but, the fact that the price of oil is going down a lot and we're not back at our US highs for equities, I don't think the realization of those lower prices going through everywhere else, especially beneficiary for consumers. And all of a sudden, their gas bill filling up their car is 25% less than it was last month. That's a real benefit, and we haven't seen it yet, right? Maybe, right? At least I haven't seen equity prices at the highs. I mean, they're trying to get back there, but I don't think we've seen it. I don't think we have seen it reverberate yet through the economy, and I think the skew in oil is also saying I don't think we've seen the end of the downside in this yet either. That's another thing, because OPEC, I like that tinfoil hat thing. They're not cutting production. Maybe they're trying to squeeze those oil sands producers and stuff like that. But at least for right now, the skew is telling us they're not too worried about prices bouncing back anytime soon, but they are worried about oil prices dropping. So it doesn't look like, and personally, I don't think it's done either, because it was way too quiet of a drop to mean there can't be more on the way. So usually those little silent ones are the ones that are scarier when it comes to, a big move like that. So I will wait. And of course, it just costs me less money to fill up my car as I drive my kid to hockey. So it makes me happy.
Yeah, there are worse things.
Yeah.
We're all natively short crude at the end of the day when you break it down.
Everybody has an embedded short position, whether you like it or not.
Exactly. Moving on to some other products that have been exhibiting some interesting movements and some vol. We talked on recent shows as well about the metals and how they were, for a while there, marching in lockstep with crude and both showing pronounced investment skew. That has since come off to the point where we saw pretty much the old commodity smile sneaking back in there. That caused a lot of us to pontificate as to what the driver was for some clear upside volume in products like gold options and indeed silver options. And we were doing our futures options show on the network this week, and I had a chance on Wednesday to parse some of that volume. And before we get into what we're seeing out there in the skew, let me just tell you guys here what we saw for some of the big movers. This is from pulling up from Wednesday, so this is from the end-of-day data on Tuesday's session on the 21st. But the big top 10 hot strikes out there in the big gold futures options for that session. We saw 5,000 of the DEES 2006 2100 calls going up that day. We also saw about 4,000 of the DEES 2006 1800 calls going up with crude. Remember, right now, crude's hovering right around the 1,200 range or so, listeners, 1,260 or so, I believe. So these are substantially out of the money calls. You filtered on a few other spots on that list. The number 5 spot on that list was 1,000 of the DEES 2006 3,075 strike calls. So there is some serious, crazy, call it what you will, optimism, insanity, maybe a little bit of both going on up there. So clearly the other side of the skew, the call wing, is seeing some action out there right now in the big futures options. And I don't have the silver up here, but I'd imagine there might be some commensurate paper out there. And looking at the skews for both of these, they're starting to reflect that, with the call wing getting a little bit more love out here in the gold, and silver actually starting to lean a little bit more put heavy again. So that's kind of interesting in and of itself as well. First off, Jared, what's your take on that crazy paper we're seeing out there in the big futures options, and also your take on what you've been seeing out this past week from a metals vol perspective?
Yeah, this is one of those situations where I think you get a big market move and then people decide that they need to reposition. And I think it's this is just my own opinion here, but I don't see any significant change, any real meaningful change in the fundamental case, at least for precious metals. I don't know about industrial metals here, but at least in precious metals, I don't see any new investment thesis, and I think that this is probably more to do with positioning and shorter term outlook. Is kind of my take. There's, to the extent that the gold is going to be tied to inflation expectations and break evens, I think there's been a lot of enough of a move in fixed income to motivate some of those traders who think they have a link there to reposition in gold. Other than that, though, like I said, I think I say most of the time when we cover precious metals, I'm not clear on what the investment thesis would be that would make you rush for for gold or silver here. Although I did see that Sprott, one of the very public fund providers, did not hesitate this week to say that new Ebola cases provided a new justification for why silver and also gold might break out this year. So I think that sort of ghoulish, no holds barred approach to marketing precious metals seems to be alive as well.
Yeah, so you're saying you don't see a case for why you'd want to load up on perhaps 1,000 Dees 2006 3,075 strike calls in gold? You don't see that case clearly, Jared?
Hey, look, if somebody wants to buy them, we can find a seller. That's not a problem. But for myself, my own account, not so much.
I think they might have found a seller or two already, so maybe someone beat us to the punch. I'll have the disclaimer, I haven't dug in to see if they were buying or indeed selling. Maybe we should be charitable and assume they were selling those calls very aggressively. But still, just the paper just really caught our eye this week on the Futures Options Roundtable. Check out that program, listeners, if you'd like to dive into the commodity stuff a little bit more than we can on this show. But before we dive off the metals, I know, Andrew, you guys over there at the pit like watching the big metals ETFs, the GLDs and the SLVs. What's your take on what's been cooking out there in metals land over the past week?
I'm still of the mind, I think that those metals are dead. So I don't know what people are buying all that. All of our, we have a couple of gold bugs, and what will be exciting to me is when everybody really thinks they're dead and the volatility is in the total can, and then gold will reignite again, I'm sure. So it's what's weird is, at least when you heard this talk of QE, gold used to rally a little bit, and I guess we've gotten a little rally from the lows at the beginning of October. As we of course, we had another kind of wild and raucous Rocktober, but it's not, there was some QE a couple days ago, right? Wednesday, the GLD hit like 120, and since then it's just sort of, right? And the difference is, though, I think the gold is falling because maybe they're really not going to do any more QE. They just job on it, but stocks still go up. So I think that trade feels a little bit dead for the metals, at least for the short term. And, you are starting to see volatilities get back down again for that product, and the volatility usually only goes up when there's some expectation of gold really, starting to fly again. So we're not really seeing it. The price of gold is going down, volatility is going down, and there's a point there where the juice becomes interesting for me to buy. We're not quite there yet, but it's I got to say it's getting there again. So we'll see. But for now, the clients mostly look at it and they see it mostly as a put right. It's gold's probably done dropping a lot, and you see stuff like broken wing flies and ratio put spreads and stuff like that to try to grab a little of that. And it's mostly the gold bugs anyway, but they're not, it's more like sell some puts to get long. It's not buy some calls to get long type of activity.
All right, I want to make sure we have some time to get to some listener questions, so we'll do a really quick rundown of the international volatility scene. Mr. Jared, I know you spent a lot of time watching vol movements beyond our domestic U.S. borders here, so what caught your eye over the past week, sir?
Like you might expect, this most recent rally in implied vol and in U.S. markets was not restricted to the U.S. It was felt around the world. And so you've still got a lot of the same phenomena that we talked about at the top of the show evident in international equity markets. Relatively flat term structures, relatively high volatility skew where the puts have been bid up significantly more than call wings. And that's, I think, true in most developed equity indexes. One thing that did catch my eye this week was very high implied correlation in Japan. We're talking about the 95th percentile or so in shorter term implied correlation. If we have to assign some causality to that, my pick would probably be incoming new allocation from the government pension fund that's coming down the pike very shortly, potentially before they may even start trading and investing before they announce their schedule in order to get ahead of the market. And so people are trying to suss out that potential market moving information, and the fact that the pension fund's probably going to have to allocate pretty broadly means that there's a good case for higher correlation, I think, in Japanese equities in the very near term. And so that kind of makes some sense, but I think it's also potentially a very interesting place to look for some opportunities. Otherwise, the data, the economic data this week has been so different than what we saw last week. Last week and the week before, anyone could talk about was growth concerns. This week we saw really great growth number out of the United Kingdom versus the rest of Europe. But, earlier in the week, purchasing managers indexes for China and for Japan, and even for Germany and France were more positive than anyone had expected. So the growth scare suddenly looked like not such a thing to worry about, at least for very short-term downside. And as a result, you saw implied vol come off in a lot of those markets, and things quiet down from there.
Sounds good. Thank you for that. Our quick glance across the borders here from a volatility perspective. And now, because we want to make sure you guys get a few moments in the old spotlight, we're going to keep on rolling right on into our volatility voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, listeners, you know what time it is. It's time for you guys to make your questions and comments and insights known to us here and to your fellow listeners on the Volatility Views panel. This one's been burning in my inbox for a while. If you've been listening to the show for a while, listeners, remember our old co-host, Mr. Don Schlesinger. He still listens to the show actively and writes in on a regular basis with a lot of his ideas for the show and feedback. And he wrote in with some interesting insight into a listener question, and actually his own response to a listener question that came in, remember, a few episodes back. It was this question. It was, let me leave you with this question. The listener, I don't have the listener's name here. I should have pulled that up. Long term, which do you think will outperform a dynamically hedged SPY at the money straddle or a dynamically hedged VIX straddle? They should be roughly equivalent, but clearly they are not. If I recall correctly, I believe Mark was on that episode. I think Mark and I fell down the side of the SPY, the SPY at the money straddle hedge dynamically. Jared, as he is wont to do, I think was a little bit more on the fence, VIX versus SPY. Don writes in with his own estimate on the predicament. He writes, when you dynamically hedge and at the money straddle, meaning keeping it reasonably delta neutral throughout, you're making a bet that the implied vol at which you buy or sell the options will turn out to be higher or lower than the actual volatility of the underlying goes on to display during the life of the trade. So the first decision to make, which the writer didn't address when he asked about outperformance, is whether he was of a mind to be long or short the straddle. That's true. He didn't mention that. Don goes on to write, naturally, being of sound mind, the only acceptable thing to do is sell the straddle. Don, as you know, a very big fan, a proponent, you might say, of selling volatility. He goes on to write, as historically the implieds of the options are virtually always higher than what the realized vol of the underlying turns out to be. So now that we've decided to sell these straddles and dynamically hedge them, trying to earn the spread between implied and realized vol, the question is which underlying might provide on average the better profit potential. Typically, SPY implieds average 2 to 4 percentage points over realized, but of course there is great variability in that spread, which even goes negative ever so briefly from time to time. Unfortunately, I no longer have access to the comparable numbers for VIX, but of course we're now talking about making a bet not on the volatility differential between implieds and realized for an equity index, but rather for implied volatility itself, which means that the values we're dealing with are much higher in the 90s as opposed to in the teens. Again, I don't have the numbers, but I am guessing that the average spread between what amounts to implied vol of vol and actual vol of vol is somewhat greater than that of those same concepts applied to SPY. So I'm guessing that for the strategy under discussion, the vehicle of choice would actually be VIX. And of course, it goes without saying the only sane thing to be doing with the straddle would be to sell it. Perhaps next show you could share these with the listeners and with the panelists and see what everyone thinks. Thanks, Don. Well, Don, we love it when you write in. That is an interesting point. You're right. When you think about it in that perspective, when you're actually selling the implied vol of implied vol, essentially, there could be chances for a little bit more premium rather than the old hedging dynamically SPY. So, Jared, maybe it turns out that your fence sitting has benefited you after all. What do you think about Don's response to that listener question?
Don makes a good point, a point that he's made, I think, in print and other places before, too, which is that sometimes the nature of the construction of the VIX index makes it more complicated, more complex to manage than people sometimes realize. And especially it becomes difficult when we're talking about managing very conceptually specific sorts of risks and premiums and potential inefficiencies in the market. If you're going to do something like that, a systematic strategy, it's essential to be clear on what you're talking about so that you're not just accidentally trading noise or just getting lucky for a short time or something like that. And Don is one of the top people, I think, when it comes to presenting, advantages and disadvantages of different ways of thinking about volatility. So with all that said, as important as the conceptual stuff is, I think that there's also a relevant empirical question, which is just historically, if you go and you sell straddles on VIX and you sell straddles on SPY or on SPX, and you delta hedge them, what are your returns like and what are the risks like? And I think ultimately that's the most important question when it comes to this sort of systematic comparison. My own take, as far as I can tell, is that the risk premium in a short VIX straddle hedge with VIX futures, which isn't a perfect replication, as Don would probably be the first person to point out, but it's the best you can do. But that even in spite of that limitation, as far as I can tell, the premium in VIX options is actually a bit greater in risk-adjusted terms than it is for a comparable S&P position. That could change. It could change tomorrow, and it could have already changed in recent months, and we wouldn't even know about it in a really clear way for some time, which is true of any strategy, of course. So all those disclaimers are as important as ever. But if we're going to think in terms of empirical data and what's worked and what's worked best, like I say, my own take is that the premium in VIX options may actually be a bit richer.
Mr. Rock Lobster, what do you have to say here for our friend Mr. Schlesinger, who I'm sure you miss dearly, along with many of our listeners?
I do. He actually, when I wrote one of my blogs, he's like, hey, you're saying that all wrong, Andrew.
Don being a little bit snarky and ornery, I can't believe that, sir.
He was both snarky and ornery, but I was I was using poetic license to make a point. And he basically told me there is no poetic license. No,
there is no poetic license when it comes to Vol and Don. You speak truth or you speak not at all, sir.
He goes, there will be no poetic license for you, young man. You can take your poetic license and stick it in your hat. However, like anything, what I try to teach our option pick clients is, as Don says, statistically, most of the time, options are a sale. However, there are some of those times where options are a awful sale. So that's when Don takes the chips. He doesn't sell any. So as far as, as a strategy, there's a lot of literature around options is about a strategy. I'm going to be an option buyer. I'm going to be an option seller. I'm going to be an iron condor trader. Okay, that's all okay. However, I think if you're a little more flexible in how you think, that sometimes straddles might make a good purchase. Well, most of the time, maybe an iron butterfly makes a good sale. If you add a little flexibility to your thought, that's, I think, a better question. I just don't think anything works. The only thing that really works over time, is probably being long the U.S. equity market. Right? If you go 200 years, it works, right? So you got two saw the bull. If you sell puts, as long as you have enough money, you'll probably be able to make it through most things if you have enough money. As a long-term strategy, that's the only thing that I can think works. So I like selling puts just as much probably as Don does. But I think for somebody that's new or they're looking at a strategy like this, there are times that one thing about everybody forgets is the directional component of selling any straddle. Vol could be coming in, but it can keep going in one direction. So that's the dynamic hedging aspect of it. So there are those strategies, like I said, tell clients it's not just the fact that, I'm a straddle buyer and that's what I do all the time. There are good times to buy straddles and bad times to buy straddles. As far as VIX versus SPY, it feels like VIX is almost always the most expensive stuff. But once you're talking about at the money, maybe the conversation's a little different because most of this skew exists out of the money and not really at the money. So it's probably not as bad as you would think, one versus the other. But I would have to guess if you look at near-term volatility, let's say in the SPY, you can get that really depressed contango for implied volatility at the money, which you usually don't get for VIX. It's always seems to be at some sort of a premium almost all the time. And you do at least get some severe short-term compression for SPY, which probably would make that a better purchase if you're going to buy something. That's how I would think about that.
All right, listeners, surprise, surprise, we ran a little bit long. Don always takes us down into the rabbit hole of volatility, but it is a fun place to go. So I think what we'll do now, because we have to wrap up, is we'll just do a quick combo crystal ball segment plus what's coming down the pike for you guys. And maybe, Jared, we'll start with you. Give us your quick, wild, indeed reckless prognostication for the week to come from a volatility perspective, as well as what our listeners can expect from you folks over there at BGC Partners.
For the week to come, I think we see a more of a gradual, slow leaking out of premium, a slow decline in implied vols as the market kind of normalizes still. For the longer term, I'm looking for moderately higher realized vol for the remainder of this year and next year. And what that means on a short-term basis, I think, is more interesting stories, more interesting developments in the markets as things start to shake around a little bit and move around a little bit. That always kind of creates more potential for dislocations and for interesting developments. So in terms of what's coming down the pike, product-wise, I've actually started doing a daily note looking at some of these interesting stories that I just referenced, because there's so many things happening right now in the market, just under the surface, or in some cases right on the surface of the market, that are notable. And you've, after a year of extremely low vol and nothing much happening in a lot of places, now I think there are some really interesting developments at the country level, at the sector level, and across asset classes. And so we're putting out a daily note looking at some of these opportunities, as well as continuing with some of the more in-depth and systematic projects.
And Mr. Rock Lobster, same question to you. What's your wild, reckless vol prognostication for the week to come? And also, what can our listeners look forward to from you guys over there in the land of the pit?
My reckless prognostication is 15.5 on the VIX for next Friday. I'm not going to disagree with Jared too much, but if you get for up 1% or down 1% once, twice, or 3 times this week, it won't surprise me hugely. But I believe we have some Fed speak on Wednesday, and that probably keeps up any latent volatility, and then it will go into the dumper by Thursday, Friday, and that's when we'll probably see that number. I don't expect to see that though, and we're not seeing the weekend effect into the close. So that's where I am. That's where I am.
All right. Thank you for that, sir. And, of course, that's going to do it for us here on the old Volatility Views program. On behalf of Jared and Andrew and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And, of course, for sending in such great questions, including Don. I know Don stole out of the spotlight this week, listeners, but we got more questions from the rest of you coming in. And, hey, who knows? You write a question in, maybe we'll get some responses to your questions as well and get some nice, great back and forth going amongst you guys. So keep those questions coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. Or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or Facebook.com/The Options Insider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.